Here's a number that should make you put your coffee down. $12.6 trillion. That's the total value of Australia's residential property market right now. To put that in perspective, that's bigger than the entire GDP of Japan. That's more wealth than the combined stock market value of every company listed on the ASX, multiplied by 4. And according to the ABS, 55.8 cents of every dollar of Australian household wealth sits inside that number. So when cracks start showing in a market this size, and they are showing, it doesn't just affect property investors. It affects every single Australian, whether you rent, own, or are desperately trying to get in. In this video, I'm going to show exactly where those cracks are forming, which 6 cities are most exposed, and here's the part no one else is telling you. Why the usual advice to just buy and hold might be the most dangerous thing you can do right now, in the wrong market. Let's get the numbers on the table first, because this is important. According to Cotality, that's the company formerly known as CoreLogic, Australia's National Home Value Index rose 8.6% over 2025, and the total value of residential real estate hit $12.3 trillion by December. That sounds incredible, right? The market's booming, everything's fine, except the RBA raised the cash rate to 3.85% in February 2026, then raised it again in March to 4.1%. That's 2 rate rises in 2 months, after a period where everyone thought cuts were coming. And according to Moody's, Australia's National Housing Affordability reading, which measures what percentage of your take-home pay goes to your mortgage, has now hit 29.6%. In Sydney, it's 40.4%, nearly half your income. Before groceries. Before school fees. Meet Tom. He's 34, lives in Brisbane, bought in mid-2023 with a 10% deposit and a $750,000 loan. At the time, he was stretching his budget, but he felt okay about it because everyone said rates were coming down. Instead, those 2 rate rises mean Tom's monthly repayments just jumped by roughly $300. That's $3,600 a year, on top of a cost of living crisis that's already squeezing him. Tom is not unusual. Tom is the story of hundreds of thousands of Australians right now. And the thing is, most YouTube videos about the housing market are going to show you a national average and tell you everything's fine. What I'm going to show you today is why the average is lying to you, and why the next 18 months are going to sort Australian cities into 2 very different groups. Here's the stat that blew my mind when I dug into the latest Cotality data. Perth home values rose 26% over the past year. Melbourne rose 2%. That is a 24 percentage point gap between 2 Australian capital cities in the same country at the same time. That's not a market. That's 2 completely different economic realities sharing a time zone. And here's why that matters for you specifically. Sydney dwelling values fell 0.6% in April 2026 alone, and are now sitting 1% below their November 2025 peak. Melbourne values dropped another 0.6% that same month, and are still 2.3% below their all-time high from March 2022, 4 years ago. Meanwhile, Darwin surged 19.6% over the year. Brisbane and Adelaide are still running hot. Perth is being described as a runaway train. So when the Reserve Bank looks at the national housing market and makes decisions, they're essentially writing one prescription for a patient with 6 very different conditions. A rate hike that slows Perth might absolutely crush a struggling outer western suburb of Melbourne. The takeaway is simple. The postcode matters more than the market. If you're making financial decisions based on headlines about the Australian property market, you're flying blind. Right, here's where it gets ugly. The National Housing Supply and Affordability Council published a report stating that the median income household now needs to spend 50% of their income to service the average new mortgage. 50%. The internationally recognized definition of housing stress is 30%. We are not just in the housing stress. We are 20 percentage points past it for the average buyer. It took 10.6 years on average in 2024 to save a 20% deposit, and only 14% of homes for sale nationally were affordable to a median income household, the lowest on record. In Sydney, that figure drops to 10%. Now Moody's, not some blog, one of the world's top credit rating agencies, has warned that worsening affordability raises the risk of mortgage delinquency and default across Australian residential mortgage-backed securities. They specifically called it a credit negative. Let me translate that out of finance speak. Moody's is saying that a meaningful number of Australian mortgages are starting to look wobbly, and here's who gets hit first. First, home buyers who entered the market in 2023 or early 2024, many of them with loan-to-value ratios above 80%, meaning they borrowed more than 80% of the property's value. They have the least equity buffer. If prices soften even 5 to 10% in their suburb, they could find themselves underwater, owing more than the property is worth. Tom from Brisbane? That's exactly where he is right now. Watching his suburb's auction clearance rate quietly drop from 72% in late 2025 to well below the decade average today. Can I ask you something? How much of your total net worth is tied up in your home or in your super, which invests in property? If your answer is most of it, which for most Australians it is, then what happens to the housing market is not just property news. It's your financial future. Keep watching. You've probably heard the government's fix for the housing crisis. Build 1.2 million new homes by 2029. Sounds great. Here's why it almost certainly won't happen on time. And why, even if it did, it might not fix prices where you think it will. Building approvals rose 12.83% year-on-year in 2025, according to ABS data, which sounds promising. But here's the catch. Total advertised stock in December 2025 was still 20.6% below the 5-year average. We are building more, but we are starting from such a historically low base that supply remains desperately tight. The National Housing Supply and Affordability Council's own report was blunt about the structural problem. The construction industry consistently faces labor shortages, approval delays, and material costs that make new supply unfeasible in many regions. And here's the twist that almost nobody is talking about. New supply is not being built where demand is highest. The biggest shortfalls are in inner-ring suburbs of Sydney and Melbourne, exactly where prices are most stretched. The approvals that are going through are mostly high-density units in fringe suburbs or regional areas. Meanwhile, according to CBRE, vacancy rates in capital cities are expected to fall further, from 1.8% today down to 1.1% by 2030. So the supply is coming, but it's coming to the wrong places, at the wrong price points, and too slowly to matter in the next 2 to 3 years. If you're a renter hoping for relief, median apartment rents are forecast to grow another 24% across capital cities between now and 2030. That is not a typo. Remember when the whole market was pricing in rate cuts? As recently as mid-2025, most economists and bank analysts were forecasting that the RBA would cut rates through the year and give mortgage holders some breathing room. That is not what happened. Core inflation picked back up. The RBA held through late 2025, then raised twice in early 2026. The Westpac-Melbourne Institute survey, which tracks how Australians feel about buying property, showed the time to buy a dwelling index falling to 82.9 in March 2026. The long-run average is 120, and the deterioration was most evident among households with a mortgage. People with mortgages are the most pessimistic they've been this entire cycle. Auction clearance rates peaked at 72% nationally in late September 2025. By early 2026, they had fallen well below the decade average of 64%. Vendor discounting, which means sellers having to drop their asking price to get a deal done, has ticked up to 3.1% across the combined capitals. These are not crash signals, but they are softening signals. And in a market where many homeowners have been relying on the assumption that rates would fall and values would keep rising, reality is arriving with a thud. Let me be direct. Based on current data, here's how I'd rank Australian cities from most exposed to least. Starting with the most exposed. Sydney, affordability at 40.4% of income, values already 1% off peak, vendor discounting rising, buyer confidence collapsing in inner-city units. Next, Melbourne. Still 2.3% below its 2022 high, unit oversupply in inner suburbs, weakest price growth of any major capital. Then Hobart. Values are 2.1% below their record high from March 2022 and struggling for any catalyst to recover. In the middle of the pack, Canberra, up 5.6% annually, but public sector employment sensitivity means it's vulnerable to any federal budget tightening. And Brisbane, strong growth but affordability now at 31.7%, the second worst in the country. What was considered affordable 5 years ago no longer is. Most resilient right now, Adelaide. Population growth, relative affordability at 28%, strong infrastructure investment, still running positive momentum. And then there's the wild card, Perth, up 26% in a year, now closing in fast on Brisbane's median house price. The question isn't whether Perth will correct at some point, it's when. All right, here's the part most people will disagree with me on. But I think it's the most important thing in this video. Everyone is talking about whether Australian house prices will crash. And the honest data-backed answer is, probably not at a national level. The RBA has estimated that less than 1% of Australian households are in negative equity. Unemployment is sitting around 4.3%. The banks have a 3% mortgage serviceability buffer baked in, and 55.8% of all Australian household wealth is sitting in residential property, which means neither the banks, nor the government, nor the RBA wants a crash. They will intervene before that happens. But, and this is the twist, no crash is not the same as you'll be fine. If Sydney values tread water or gently fall for the next 3 years while inflation keeps running at 3 to 4%, your real purchasing power, the actual value of your asset, quietly shrinks. You don't lose on paper, but you lose in real terms. That's happened before. It happened in Melbourne between 2017 and 2022. People held the whole time, and in inflation-adjusted terms, they went backwards. The property market is not a monolith. Some suburbs in Perth or Adelaide will keep outperforming. Some inner-city Sydney unit markets are already in real distress. The investors who win over the next 5 years won't be the ones who bought Australia. They'll be the ones who bought the right Australia. And yet, 86% of Australian households are priced out of buying in their own market right now. For most people, this isn't an investment strategy conversation. It's a cost of living crisis that the government has failed to solve, and arguably made worse by pumping demand through first home buyer schemes that simply inflate prices further. The uncomfortable truth is that Australia's housing market works perfectly if you already own property. It is catastrophically broken for everyone trying to get in. Right, let's wrap this up with 3 things you should actually take away from this. 1. Stop thinking nationally. The Australian housing market doesn't exist in any useful sense. Sydney, Perth, and Darwin are 3 completely different economic stories right now. Before you make any decision, buy, sell, invest, or hold, look at suburb-level data from Cotality, PropTrack, or Domain. Not the headline number. 2. Stress test your mortgage at 4.5% or higher. Not because I'm predicting rates go there, but because the last 18 months proved that rate expectations can flip completely in a few months. If your budget only works at today's rate, you're carrying more risk than you probably realize. 3. If you're renting and feeling hopeless, the data is bleak in the short term, I won't sugarcoat it. But regional centres with infrastructure investment and population inflows. Think Geelong, Wollongong, Townsville, Newcastle. Offer meaningfully better affordability and are being supported by genuine supply investment. It's not live in the CBD or give up. There are livable, affordable options if you're willing to look 60 to 90 minutes out. Now here's my question for you, and I genuinely want to know. Are you more worried about being priced out of the market forever, or about buying in right now at the wrong time? Drop your answer in the comments below. I read every single one, and it'll shape what I cover next. If you found this useful, not liked it, actually learned something, subscribe. Because every fortnight I dig into Australian financial data that most media outlets either don't cover or dress up with spin. No product recommendations, no affiliate links, just analysis. And if you want to understand the other side of this story, why some investors are actually excited by what's happening right now, watch my next video on the specific suburbs in Adelaide and Perth. that are still genuinely undervalued by the metrics that mattered most before the last 3 property cycles. See you there.